The Dow just crashed 800 points in a single session. Oil spiked to $80 a barrel. Iran fired missiles at oil tankers. By every measure, this should be a catastrophic day for stocks. But here's what nobody's talking about. While the market was bleeding red, three specific sectors gained over 20%. Not 2%, not 10%, over 20% in a single day. Most investors see chaos. Institutional money sees opportunity. Today I'm going to show you exactly how the smart money makes billions when everyone else is panicking. Let me show you the numbers that matter. West Texas Intermediate crude futures didn't just rise. They exploded past $80 per barrel for the first time since July 2024. That's a 15% spike in 48 hours. The trigger? Iran's direct missile strikes on commercial oil tankers in the Persian Gulf. Not threats, not rhetoric. Actual weapons hitting actual ships carrying actual oil. Here's where it gets interesting. The S&P 500 dropped 3.2%, wiping out $800 billion in market cap. But look at this data. Energy sector ETFs surged 22%, defense contractors jumped 18%, and shipping companies rocketed 24%. The market isn't broken. It's rotating, and institutions saw this coming. Most people think war equals market crash. Institutional investors think war equals sector opportunity. Bank of America's flow data from the last 72 hours tells the real story. While retail investors dumped everything, $2.1 billion in panic selling, smart money was buying specific plays. Defense stocks like Lockheed Martin, Raytheon, and Northrop Grumman absorbed $890 million in institutional inflows. Energy names like Exxon, Chevron, and ConocoPhillips saw $1.2 billion in smart money accumulation. This isn't random. This is a playbook. When geopolitical risk spikes, institutions rotate from growth to what I call crisis beneficiaries. Here's what 100 years of war market data shows. During the 1973 oil embargo, the S&P fell 17%, but energy stocks gained 87% that same year. Gulf War, 1991, market initially dropped 10%, then surged 29% as defense spending exploded. Iraq War, 2003, tech crashed, but oil services companies tripled. The pattern is clear. Initial panic sells everything. Smart money buys the specific sectors that benefit from conflict. Then the broad market recovers once the war premium is priced in. We're currently in stage 1, the panic phase. Institutions are positioning for stage 2. Here's exactly how this works. When oil jumps 15% in 2 days, it doesn't just affect energy companies. It creates a cascade of winners and losers that institutions map out in advance. Energy companies obviously benefit. Higher oil prices mean higher margins. But so do tanker companies, because dangerous shipping routes command premium rates. Defense contractors win because military spending accelerates. Even coal companies surge as alternative energy sources gain value. Meanwhile, airlines crash because fuel costs spike. Retail suffers because consumer spending drops. Growth stocks get hammered as investors flee to safety. The key insight: institutions don't buy the market during crises. They buy specific beneficiaries. Right now, institutional ownership data shows something fascinating. In the past week, before this crisis hit, smart money was already accumulating energy and defense positions. Vanguard increased energy exposure by 12%. BlackRock added 800,000 shares of defense ETFs. State Street doubled down on shipping stocks. They didn't know Iran would fire missiles this week, but they knew the probability of Middle East escalation was rising. They positioned accordingly. This is how institutional money works. They don't predict events. They position for probabilities. Here's what institutions are watching next. Oil inventories are at 10-year lows. The Strategic Petroleum Reserve is 60% depleted. Iran controls the Strait of Hormuz, where 20% of global oil flows. If this conflict escalates, and geopolitical analysts say there's a 70% chance it will, oil could hit $100 per barrel. That would trigger another massive sector rotation. More importantly, we're entering the spring driving season when oil demand peaks. Institutions know this. They're positioning now for what could be the biggest energy crisis since 1979. The lesson isn't to panic when markets crash during geopolitical events. The lesson is to understand how institutions think about crisis investing. They don't see chaos. They see rotation opportunities. While retail investors sell everything in fear, smart money buys specific crisis beneficiaries. Today's 800-point Dow drop isn't the end of the story. It's the beginning of a sector rotation that institutional money has been positioning for all week. Remember, in markets, panic is temporary. Positioning is profitable. If this breakdown of institutional crisis investing was valuable, subscribe for more smart money insights. And I'll see you in the next video.